So welcome to tonight's Farmer Advisory Service webinar. I'm Laura Henderson and I'm going to be chairing tonight. So this is the third and final webinar of our new Entrants Finance Course. We started off in person back at the beginning of February in Perth, Huntly and Lanark, where we looked at business structures, finance sources and business planning. The slides for these events are available. Then we kicked off our webinar series on the 12th of February with bookkeeping and VAT, where we got an overview of all the different VAT rates and rules that businesses must apply. Then last week we had a whistle-stop tour through the contents of an accounts from our profit and loss to our balance sheet, and then how to interpret some of these things. And tonight we finish the series with cash flow, and that's probably one of the most common things that I get asked about as a consultant, and certainly quite a challenge for many agricultural businesses up and down the country. I'm sure you're quite aware of who he is now after the last few weeks, but Andrew Coalter is a chartered accountant who currently works for SEC Consulting based out of Perth, and he previously worked in practice, so he's well rehearsed in all things accounting and especially cash flow, because that's part and parcel of his daily work, is creating these cash flow forecasts for many clients.
As has already been introduced, my name is Andrew Coalter. I'm a consultant out of the Perth office with SAC. I'm assuming that you're all quite familiar with me at this stage, but as Laura said, I have a background as a chartered accountant, which means that within SAC, alongside the general agricultural consultancy work that I do, I also take quite a bit of responsibility for the business work that our consultants undertake across the country in terms of helping with training, helping developing different tools that we use, and just as a touch point, somebody can answer queries internally as well. So this evening we're going to be looking at cash flow forecasts. As Laura rightly said, this is an area of work that we see cross our desks quite a lot as consultants. There's a number of reasons why you might want to consider your cash flow, why you might want to plan for it and create cash flow forecasts. So we'll go through all of that this evening. As Laura's already said, this is part of a new course that we are trialing, which is designed for the next generation of people coming into agriculture. So that not only covers new entrants, it also covers people perhaps taking over farming businesses for the first time, or any other scenario that falls in between. So on the back of that, in line with some of the other webinars that we've done, we're trying to keep the content relatively straightforward. Hopefully the content here isn't too simplistic, and there's a lot that you can take and apply to your situation. So we're really covering the concepts from the ground up and then taking that forward to say, well, actually, what is a cash flow forecast? What is cash flow in the first place? Why do we care about it? How do we create a cash flow forecast, and how do we monitor a cash flow forecast to know if we're doing well or if we're doing poorly? As Laura said already, fire any questions you have as we're going along into the question and answer box, and I'll try my best to answer those at the end. So the first question is, what is cash flow in the first place? It can be summed up in a variety of ways, but to really just simplify it down, it's basically the measure of movement of money in and out of your business, or in and out of your business bank account. Doesn't matter how it's displayed, it always comes down to the same basic principle that money in minus money out is your net cash flow. Ideally, we want to see a net cash flow increasing for a number of purposes. But it might be the case that while it increases over a year or over a longer period, that there's decreases, let's say, on a monthly basis, and it's being able to manage those decreases to be able to see you through the rest of the period that you're dealing with. Cash flow is really important for business success. I touched on this last week when we were talking about accounts in that webinar. Just because a business is profitable, it doesn't mean that it'll necessarily going to survive. It doesn't matter how profitable the enterprise that you have is. If you run out of cash, your business effectively dies. We're in a really strange situation in agriculture, where in a typical farming year, whether that's for crops or whether that's for, let's say, breeding livestock, you have all of your costs up front. So we have the cost of planting a crop, fertilizing the crop, spraying the crop, and we don't get any of the income until after it's harvested, and the majority of those bills are paid for as well. So actually we have all our outflows before we have any money coming back in within each of those specific enterprises. So it's been able to ensure that we can manage our cash flow and our cash availability to get through those perhaps more difficult those difficult times in our cash flow forecasted period. In the good times, building up cash reserves and monitoring that when our cash reserves are building, it gives us the impetus and the ability to go and reinvest in our businesses. In the bad times, if our cash flow is particularly poor, we can knuckle down and we can plan for that and make sure that we're only covering essential bills and purchases and make sure that we're protecting ourselves from long-term damage there. So I've sort of touched on the first point that profit is not the same as cash. And I did have an exercise last week to that effect. That's a point that I really need to drive home because there are many good business ideas that come across my desk, whether that is diversification ideas or whether it is expansion ideas. It might be that you want to build a new shed to expand production. You might want to buy more land. Whatever it is, it might be the case that that new enterprise is profitable over the course of a year or over the course of several years, but you need to have the cash flow in place and the finance available to see you through all the costs so you can get to a stage of profitability. So profitability within itself is your revenue minus your expenses. Generally, we're looking at that over a fixed period. Quite often that's a year. It can be for whatever period you want to do for your own management purposes. But typically, if we think of this in an account setting, we look at that profitability over a year. As I've already said, your profitability might be positive, but you can still struggle with cash shortages. On the other hand, with your cash flow, this is less about how profitable your business is, but it's the measurement of when money is actually received and when money is actually paid out. If you run out of cash and expenses before you make your income, your business might not survive. So the fundamental difference here is that profitability is really important. Don't get me wrong. And actually profitability is really important for long-term success. But actually cash flow and the management of cash flow is needed for that daily survival, weekly, monthly survival of your business. And good cash flow management, make sure you don't run out of money before the income arrives, before the reward for all the effort that you've put in arrives. So if we want to create a cash flow forecast, we need to consider each of the different elements that come into it. So I've said already that in its simplest form, a cash flow forecast is to take all of your cash inflows, take off all of your cash outflows, and you get a net cash flow position for the period that you're covering. So in terms of your cash inflows, we've obviously got your sales, whether that's livestock, crops, it could be rental income, it could be, any sort of diversified income that you have. Beyond that is thinking about other sources of cash into your business. A common one is the subsidies that we receive. It might be things like way leave income, compensation, insurance claims, that's all cash inflows. If you take out loans, the receipt of those loans is a cash inflow that you need to consider as well when creating a cash flow forecast. On the flip side, the outflows are your expenses, your day-to-day expenses for running your business. But it also covers capital purchases. So if you were to buy a new piece of plant machinery, if you were to buy a new farm vehicle, whatever that might be, that needs to come out of your cash outflow. That's not necessarily something that shows up in your profitability or your profit and loss statement in your accounts, but it does impact your cash balance. Drawings is another one, your personal drawings out of that business. Generally speaking, a lot of farmers, or most farmers, are operating with a view to make a profit. And the view to that making that profit is to support business growth, but it's also for their own income purposes to support the lifestyle and the level of lifestyle that they need to have. So they're generally speaking, there is drawings out of these agricultural businesses. Those drawings come out of the cash, generally speaking, come out of the cash reserves of that business. So we need to consider the drawings and the personal cash requirements of the owners of the business when we're considering a cash flow forecast. Ultimately, that leaves you with your net position, the difference between that inflow and that outflow. So why do we want to create a cash flow forecast. Why do we need to forward plan for this? If you know that your business has been profitable for the last number of years, you're not really changing anything, that you've been ticking along just fine. Uh, why would you bother going through this exercise? I think there's a number of really important reasons why every business should create a cash flow forecast, regardless of what stage of growth. Whether you're a new business, whether you're a growing business, whether you're a mature business, whether you're heavily leveraged or not, I think it's really interesting as a management tool to make you more informed about both how your business has performed and how you think it will perform. Managing liquidity is a really important one, and I've made that point several times already. If you run out of cash, your business can't continue. So ensuring that you can plan appropriately, that you can structure the payments that you need to make in line with the income that you have so that you can meet those liabilities. If you plan in advance and you know that you're going to be short of cash or you're going to be really close to your overdraft limit in 8 months' time, it's much easier to go to your bank manager at that stage and say, actually, I know that we're going to be tight for cash in 6 months, 8 months' time. I'd like to temporarily extend my overdraft limit for that period. That's a much easier conversation to have rather than getting there, running out of cash, having to make short-term decisions to get that finance at a costly rate. It leaves you in much better control. It gives the banks, it would build a lender's confidence if you're able to come up with that level of planning. And it also just helps you manage that. If you know that you're going to be short of cash, it might be the case that you can pull some sales further forward, whatever it might be. You might be able to push some expenditure further back. If you forecasted your cash flow and you know what your cash availability is over the next period, it allows you to plan for capital expenditure. When times are good, that's the time when we want to reinvest in our business and use those positive cash flows to advance our businesses and make changes in that regard. If cash flow is really good, it might be the case that you want to consider the level of debt you have. You might have an opportunity there to reduce it. The flip side of that is if cash flow is not looking positive, it may be the case that you put on hold plans that you had to perhaps invest in plant machinery, in new infrastructure, whatever capital expenditure that might be. And you might need to consider other sources of finance beyond just relying on an overdraft or whatever it is that you're currently doing. A cash flow forecast is a really good monitoring tool for you as a business owner. Last week, when we talked about accounts analysis, comparing year on year, if there's variations, that's fine, but it's knowing why there's variations. This is the same premise, but it's looking forward. If you create a cash flow forecast now, don't just stick it in the drawer. Take it out every month, take it out every 3 months, compare your actual performance to what your plan was. And it's a really good monitor to say, well, actually, I thought the business was going to do this. It hasn't, and why? That's really helpful for you as a business manager. It also helps you set financial goals. Those financial goals might be the growth of the business. The financial goals might be your ability to take money out of the business for your own personal use or whatever it might be. Being aware of those pinch points in your cash flow through good planning is really key. It allows for better use of finance rather than knee-jerk reactions to short-term pressures that you might face. So that's cash flows as an overview. For obvious reasons, we're going to focus now for the rest of the evening on forecasting cash flows, creating these plans, why we do them, and how we might go about them. If you're looking to get a loan from a bank, you will often need to produce financial forecasts to demonstrate the viability of the venture that you're undertaking. And cash flow forecasts are a useful way to demonstrate that. Whether this is a new enterprise that you're going into, whether it's an entirely new business, or whether it's expansion of the status quo, whatever it is, lenders will want you to be able to demonstrate that you can run a profitable business, you can afford the level of debt that you're taking on, and that you'll be able to repay that debt within a time frame that is sufficient for their purposes. I've already mentioned for you as a business manager, it's a really useful tool for you to be able to proactively manage your business and to notice problems before they arise as well. Generally speaking, we create a cash flow forecast on an annual basis, a 1 year cash flow forecast, a 3 year, a 5 year, it depends on your situation. the bigger amounts of sums of money that you're looking to borrow, the more thorough and the longer these forecasts will need to go into the future. 3 years forecast would be quite typical for a bank loan application. You can do these over a much shorter term. There's no reason that you can't do these over a monthly term or a weekly term and compare things week by week. Generally speaking, we look at an annual period, and within that annual period, we would split it into the 12 months and allocate income and costs across each of those 12-month periods within the year. It's important to remember it's not an exact science. You could spend an endless amount of time trying to perfect your cash flow forecast. No matter what happens, whatever you forecast and write in your plan is not what's going to happen. There's always going to be things that are unexpected. There will be price changes in the market, and there will be unexpected changes in your business, whatever it may be. So it's making sure that you put in a reasonable estimate of what you think is going to happen. And it's not always the best use of your time to really, focus in on the minutiae of the detail of what might be happening there. So if you want to start making a cash flow forecast, how do we go about that? How do we start to build up that picture of what your cash position is going to do, let's say over the next year, over the next 12 months? If I'm asked by a client to produce a cash flow forecast, whether that is to present to a lender, whether it's for their own purposes, whatever it is, I always start with what information we have. If you are an established business, or if you have been trading, for the last 1 or 2 years, whatever it is, if you have some previous information that you can use, that's a really helpful starting point. There's no point trying to reinvent the wheel if you already have a lot of that information there in front of you. A really useful starting point is your annual accounts that you have. If you have a consistent set of annual accounts over the last couple of years, it gives you a really good idea of the level of sales income you would expect to achieve. It's also really useful for reminding yourself of all the other sources of income that occur in your business, whether that's rental income, whether that's grant income, whether that is diversified income, making sure that you don't miss those out and looking at all the expenses as well. If somebody came to me and said, I want a cash flow forecast for my business, I get to the expense section, you get to things like insurance, or accountancy fees or bank charges. If you know what your sort of expected costs have been due to past data, that's a really good starting point to put into your forecasts already. For each of these individual lines that are on your profit and loss statement, do you have a breakdown of what is within each of those? The more detail you have on your past information, the more accurate you can make your forward-facing projections. So taking each of those lines that you have, let's say we start with our cattle sales, use your own knowledge of the business to map those out and to map out the timing of your cash inflows and outflows across the 12-month period in your 1-year cash flow forecast. Your accounts might tell you that last year you had £75,000 of cattle sales. That in itself isn't particularly helpful for a cash flow forecast, just having that one number, because that's not happening consistently every 12 months. You're going to need to use your own understanding there to spread that out and make sure that you're mapping it out in a realistic format. If it's a new enterprise that you're taking on and you're perhaps not quite sure what your income and expenses are necessarily going to be, a useful starting point would be to think about and perhaps create a gross margin for that business to say, well, actually, what do I expect the income to be? What do I expect the expenses to be as a whole? And then using that to fill in the gaps within your cash flow. It gives you a prompt for what information to include. If you don't have a clue and it's a new enterprise, a really useful resource is the Farm Management Handbook. So this is something that is produced free of charge and provided through the Farm Advisory Service. You can get print copies. You can order them online or through your local SAC consulting office. I think they cost roughly around £30 for a print copy. I don't actually have a copy one here to hand. But you can download a PDF of it online for free. It's a really useful tool. There's a couple of hundred different possible margins in there. It goes through all sorts of things you can imagine. All your traditional crop types, your wheat, barley, oilseeds, peas, tatties, all of those things. It goes through grass margins. And then the livestock side, it covers a variety of different possible livestock enterprises that might be applicable to you. And it gives you a financial gross margin, expected, a sort of forecasted gross margin for the year ahead. And it also gives you a lot of practical physical sort of KPIs in there and physical information about these as well. I have put one example on the screen here. This is from the Farm Management Handbook for this year, and it gives you a gross margin for a crop of spring barley. So depending on your expected grain yield, which is dependent on your farm type, on your land type, on your geography, it then gives some forecasted financial information here. So if we take the average number in the middle and say that we expect to get 5.5 tons of spring barley per hectare, at a sale price of £170 per tonne, that would give us an output of £935 plus another £229 for straw. So we would have an income of £1,164 per hectare. So that's quite easy to multiply that up across the area that you want to grow on your farm. It then gives us an idea of some standard costs for seeds, fertilizers, sprays, other crop expenses. So if you're taking on a new enterprise, particularly a new agricultural enterprise, whether that's a combinable crop, whether that is summer grazing cattle, whether that is fattening lambs or finishing pigs, this is a good starting point if you don't already have some numbers to mind that you could use. Knowing where all of your income and expenses fall within the calendar year is really important. And I'll shortly put an example of a cash flow forecast on the screen and you'll see how I have laid them out. For your sales, as I've said already, knowing what your total sales figure is fine if we're just looking at profitability, but actually we need to consider for cash flow purposes where these sales fall within the period. So for example, if you sell 50 fat lambs in August and 25 stores in September, well then in your cash flow forecast, that's where we expect to see the income. And the expenses for those are likely to fall much before that. Another one to consider is subsidy payments. I appreciate there's a table on the screen there which has been lifted from the Rural Payments website. That might be quite hard to see, but subsidies generally follow a relatively set payment timetable. So using that to factor it in if you don't already know. Perhaps if you're a new business and you're claiming Basic Payment Scheme or LFAS for the first time, or perhaps the Beef Calf Scheme claim if you're doing that for the first time, there's information available from Rural Payments, from the team at ARPID, to say when these payments usually commence and when they expect the payments generally to be made by. So that's quite useful if you don't already know that information. On the expenses side, it's really important to make sure we include everything and we don't miss anything out. So we've got all of the expenses that appear in your profit and loss, but there will be other cash outflows from your business. Make sure that you consider all the standing orders that are set up at your bank account, any direct debits. Have you got loan repayments that are going out every month, every quarter? Make sure they're factored in. Insurance, obviously we've got your normal operating costs. And another key one to remember is your own personal drawings. It might be the case that you take £500 a month or £1,000 a month out of the business almost as a wage for yourself or whatever you need it to be. It might be the case that you take out money on a more ad hoc basis. Try and figure out what sort of pattern that you follow in terms of your own cash needs and factor that into the cash flow forecast of the business. So here's an example on the screen of a relatively basic cash flow forecast that I helped a client produce. It's quite a small business. They were actually just starting out. This was year 3 of their cash flow forecast. It was a new enterprise. A young farmer had taken over a small unit, and he was gradually building up his livestock numbers over the first 3 years. So in year 1, his cattle sales were almost non-existent, and we were basically relying on the finance that he was borrowing to get him through that first year. But from year 2 and year 3, we were starting to see those livestock sales coming in there as his numbers increased as well. So you can see here, this screenshot is purely looking at the cash receipts. So this is the money coming into the business. These are the cash inflows. So we had some small hay sales, we have finished cattle sales, basic payment, small amount of way leaves. And actually in this circumstance, you can see that the owner of the business had introduced some of his own capital into the business to keep things ticking over. VAT is another one which I haven't mentioned so far. VAT is never an income or an expense of your business. It's effectively just a tax that we collect on behalf of HMRC and that we pay on, that we either collect or pay, and then we either reclaim it or we repay it to HMRC on their behalf. So we're really just middlemen or middlemen in the VAT process if you are VAT registered. So it's important to factor that into your cash flow forecast. So you've got VAT on all of your expenses as you go out throughout the months, but then every 3 months or however often you do your VAT returns, you'll get those VAT return receipts back in. Depending on how tight to the wire your cash flow forecast is, you may or may not need to factor that in. If your cash flow's fine and it's not that close to overdraft limits or whatever it might be, it may be a reasonable assumption to just say, we're considering that to be a timing difference. It goes out, but then it comes back in every 3 months and you can just ignore it. But if you're creating your cash flow forecast and perhaps things are a wee bit tight or the bank's looking for a bit more detail, it shows quite a bit of professionalism if you're able to say, well, actually, I've considered the VAT on all these purchases and included them in my cash flow forecasts. It's probably quite obvious, but it's really important to note that everything that goes into our cash flow forecast is on a cash basis. So whereas things in our accounts happen based on the date of invoice, for a cash flow forecast, we're always looking at things based on the date the transaction actually hits the bank statement. So for livestock sales, you might make a lot of livestock sales in the last month of your business year, but if you don't receive that money until the start of the next financial year, that's where it needs to go in your cash flow forecast. So here's the other side of that quite basic cash flow forecast that I showed you. This is the cash payment. So this is all the outflows from the business. You can see here, unfortunately, that list is a little bit longer, but overall, the net cash flow does okay over the course of the year. As this business has been building up, there's been lots of cattle have been purchased. We've got feed, we've got livestock expenses. These all come out of that gross margin that I talked about earlier when we're starting at the sort of bare bones planning stage. We're then looking at all our other costs, fertilizer costs, machinery repairs, rent and rates, property repairs, loan interest, all of those expenses that you would see in a profit and loss statement, but mapped out in the month that we expect these transactions to hit our bank statement effectively. There are a number of transactions here and a number of lines that wouldn't appear on a profit and loss statement. The first one being drawings. This business owner was forecasting that he would be taking £600 a month out of the business bank account. That was to cover just day-to-day living, groceries, utilities, all those sorts of things. That was the level of money that he could that he needed to take out of that business, so it has to be factored into that forecast. Another one which is commonly overlooked is tax. If you're making tax payments twice a year in January and July, that's something that might come out of your personal bank account, but actually it might be something that comes out of your business bank account as well. So that might need to be something that you factor into your cash flow forecast. In this case, in the month of January 2026, we have forecasted that there's going to be a capital purchase here. There's going to be £11,000 spent on machinery. When going through this process, the timing of that £11,000 in January 2026 wasn't arbitrary. It was based on cash availability within the business. You can see here that there's sort of 3 key numbers on this screen that I've highlighted in red. First one to consider is your net cash flow. So what's the net position? What's the net movement in cash flow month on month? So in April 2025, there's a small increase, but actually in May, June, and July, the cash flow drops quite rapidly. We can see that our opening balance of £24,000, that's what we started the end of the year at. And then at the far end, at the end of March 2026, we've ended the year on £19,000. But actually what we've got here is a summary of what's happening every month. Where is our cash position at the end of each month? You can see by the time we've got to the end of July, we've dipped below £10,000. We're sitting at £8,000. So actually, I know that as much as we might want to have made that machinery purchase earlier in the year, we can't afford to make that payment in July because we would physically just run out of cash and not be able to pay any of our other bills. Actually, it's been held off to the stage where we know at the end of December there's £15,000 in the bank that we can afford to make that expenditure of £11,000, and there's enough income, which was on the previous slide. There was enough money inflowing into the business, and the level of payments are sustainable that we could actually make that capital purchase. So when you're pulling your cash flow forecast together, don't forget to include your fixed costs. Don't forget to include your drawings. Don't forget to include any capital purchases that you want to make. In this position, in this example, the cash position between the start and the end of the year has actually dropped. It's gone down from 24,000 to £19,000. But that doesn't necessarily mean the business has been failing. Actually, if we were to consider the same business plan on a profit and loss basis, the business is forecasted to make a profit. But it's because the owner has withdrawn £7,000 for his own personal use. It's because there's been tax paid of £2,000. There has been capital expenditure, an investment of £11,000 in the business. These are things that impact the cash flow, but don't impact the profitability of the business. So when you're creating your cash flow, calculate the net cash position each month and adjust it based on realistic expectations. If you create a 12-month forecast and it shows that at the start of the year you had 20,000 and at the end of the year you've ended up with £150,000 and you're on a farm with 60 or 70 suckler cows, unless you're dispersing off your herd, it's probably the case that you've missed some expenditure in there. You're going to have a good gut feel yourself when you look at your 12-month forecast. Does this feel right? Does this feel realistic? And if it doesn't, it's worth bearing that in mind. Any plan that you present to a lender will be well scrutinized, and they've seen enough of these things. They're not daft. They've seen enough of these to know what's realistic and what's not realistic. Also, creating a cash flow forecast that's not realistic, it's not really helping anyone. If you create something that's not realistic, it means that, well, you're never going to be able to achieve it. So what would be the point of comparing yourself against your budgeted position? It would be a futile exercise. Making it as realistic as possible makes it much more useful for yourself as a business owner to use as a management tool. Another important thing to note that I've already touched on is that just because a business is profitable doesn't mean that it will survive. If it runs out of cash, the business effectively shuts down at that point. Having a forecast gross margin is really important because that will tell you, is your idea profitable in the first place? Is this a venture that as a whole could make a profit? But once you get all your numbers laid out in a cash flow forecast over a 12-month period, it will show you if this idea is going to work at all or not. If the cash flow is not sustainable, there's no point trying to go down that path if you're not going to be able to finance it. But on the other hand, if it's able to demonstrate that you have a profitable business idea or an expansion idea and your cash flow is able to maintain what you need it to do, well, actually, that's a really strong argument to be able to make for going ahead with whatever it is that you're planning to do. We come across a number of problems when we're creating any form of budget, whether that is a budgeted gross margin, whether it's forecasted financial statements, whether it's a cash flow forecast. And these are things we come across time and time again. The first one is the variable nature. Actually, the first two are really linked there. The variable nature of agriculture. We are at the whims of a huge number of things in farming. The big one being the weather. We can't control that. And the weather is the single biggest determinant on how well your crop does, on the availability of grass for your livestock, whatever it may be. And we have absolutely no control over that. The other big area to think about is the uncertainty in market conditions. We've got a really stark example of that at the moment in the sheep industry, but in particular the beef industry. Beef has gone from cracking £5 a kilo before Christmas, which we thought was fantastic, to cracking £6 a kilo. It's now at £6.50, and nobody really knows where that price is going to go. So there's a lot of uncertainty in that. While there's a lot of confidence in the beef trade at the moment, it could be the case that prices slip back. If you're planning for your business now, can you factor that in? Can you do, can you effectively create a sensitivity analysis? What happens if my sale prices drop by 10%? Will my cash flow be able to survive that? What happens if my costs increase for whatever reason? It's not that many years ago that fertilizer prices went ridiculous, and we were paying some businesses were paying £1,000 a ton for fertilizer. To what extent is your business able to manage if some of these core costs change? There's lots of external factors. Weather's a big one I've touched on already. Changes in regulation, changes in policy, basic payment schemes coming to the end of its life. We can factor that in for current year cash flows. But actually, it's not totally clear what the new scheme is yet. It's not totally clear what that means for on-farm payments. So that introduces a certain level of uncertainty and creates a bit of a challenge when we're trying to create these budgets. So things like that to be aware of. And if you're producing a business plan for a bank, it's acknowledging these points in addition to just creating your cash flow forecast to show that you've thought about all of these different areas and you've thought about the impact that they might have on your business. So how do we go about it? We've got the idea. We want to create a cash flow forecast either for a management tool or as a mechanism to obtain funding. It doesn't need to be overly complicated. You can do it yourself with a pen, paper, and calculator. There's absolutely nothing wrong with that. The issue with using a pen is if you make a mistake, you'll need to have plenty of Tipp-Ex to hand. What's probably a more realistic option is that you could use a spreadsheet, just use a Microsoft Excel document to create that cash flow forecast. If you want to, you could do that from scratch yourself. There are lots of free online templates for 12-month cash flows. You'll need to customize those for agricultural use, but there's plenty out there to get you going. I'll be honest, my tool of choice is a Excel spreadsheet, which I developed internally for use within SAC. If I'm creating a business plan and I'm creating a cash flow forecast for a client, Microsoft Excel is what I use. It's a really powerful tool, and if you're comfortable using it, there's no reason why you can't produce very comprehensive business plans and very comprehensive cash flow forecasts using a spreadsheet. Other things to consider is your bookkeeping software that you have. So if you use software like Xero or QuickBooks or lots of other bookkeeping software that's out there, many of them have functionality for creating cash flow forecasts inbuilt within them. Some are better than others, but it's worth having a look at if that's something you want to try. There are other standalone tools and apps online that you can use specifically for cash flow forecasting. There's one in particular that springs to mind, which is Figured. So if you use Xero accounting software, Figured is another paid add-on, which is an agricultural specific cash flow forecasting and monitoring tool. It does more than that, but in its out-of-the-box format, it's a really powerful cash flow forecasting tool for agricultural businesses. There's any range of tools that you can use to go through this process, but ultimately the principles are absolutely the same, regardless of whatever package or whatever technological means you use to try and complete your cash flow forecast. So once you create a cash flow forecast, what do you do with it? Unfortunately, for many people, they get a cash flow forecast created by a consultant like myself, or by their accountant, or by an advisor because they need it for a specific purpose. They need it for a bank loan application, or they need it to, to apply for a grant or whatever it is. Quite often, it gets printed out on nice shiny paper and it gets stuck in a drawer in the farm office. What an absolute waste of time and money for everyone involved in that process when so much effort has gone into making a comprehensive cash flow forecast. If you stick it in a drawer, that's exactly what it is. It's a waste of your time and it's a waste of your money. You need to keep it out, you need to keep using it, and you need to keep monitoring what's going on. What I would suggest is that as far as possible, you review your performance as frequently as you can. A recommendation would be to do that monthly it might be the case that that's a bit impractical and you can't manage to do that. I generally say, as a minimum, you should try and review your cash flow forecast every quarter. And why is that? Because you already have your financial records out every quarter to complete your VAT return. You have those figures in front of you. You have your bookkeeping software, your account software already open. Why not take the extra 20 minutes or half an hour it is to update your forecast with what's actually happened? And comparing what's actually happened with what you've planned. Is there a difference? If there's a difference, that's not necessarily a problem, but knowing why there's a difference is the important part. It was the same last week when I discussed an accounts analysis. You can vary from the sort of standard figures that I presented. You can vary year on year. There's not necessarily an issue in that itself, but it's knowing why there's a variation. It might be the case that there were cash inflows or cash outflows that you just forgot to include, and that's fine. You can update it and you have a more accurate plan going forward. It might be that prices have changed and gone ridiculous. Maybe it's the case that the beef price has gone up by £1.50 a kilo, or maybe it's the case that the beef price has slipped by 50 or 60 pence a kilo, whatever that might be, or energy prices have gone through the roof. There's any number of reasons there. It might be that something that was planned hasn't happened. Maybe you were planning to make a capital purchase. Maybe you were planning to sell your calves earlier or your grain earlier and you haven't done so. There might be lots of factors, maybe even out with the business, that are beyond your control. There's no issue in having a difference, but it's understanding what those differences are. And if the differences aren't for the better, it's understanding and planning what changes are needed to try and get things back on track. Signs of a positive cash flow. Over time, these are quite easy to see. If your bank account's always in credit, if you're always in the black and you actually have money available for your business, that's the ideal scenario. And ideally, we're not necessarily looking for a cash position to always be increasing. Because if your cash position's always increasing, the question then becomes, well, why is that cash sitting in a bank? Could you not be doing something better with that money rather than it just sitting there? It could be investing it. It could be expanding your business, investing for growth, or whatever it is. Signs of a negative cash flow typically are quite easy to spot as well. If your bank account is always overdrawn, that's generally a sign that there's an issue with your cash flow that you need to consider. If your overdraft is increasing over time, even if your profitability is good, again, that would indicate that there's an issue with your cash flow that you need to look at. If your reliance on debt, whether that's trade creditors or loans or whatever it is going up year on year, again, regardless of profitability, is perhaps a sign that your business cash flow is struggling and not meeting up the demands. Another telltale sign for me when I'm considering a business is if effectively the money, that income has already been spent before it's been received. If you're waiting on an income check, whether that's a milk check or a grain check to clear so you can pay other bills, generally speaking, that would be a sign of distress that I'd be trying to sort out and factor into your cash flow forecast as a bit of a reality check. So if your cash flow is decreasing, if you're not able to meet the cash requirements of your business, even if it's forecasted to be profitable, this is where cash flow forecasts really come into their own beyond just gross margin planning or analyzing a set of accounts. If you have it spread out on a month-by-month basis, it really helps you to identify where the cause is. Is this a short-term or is it a long-term issue? Common short-term issues might be that you've just had too many expenses up front and actually you're not going to be able to meet all of those expenses before you start getting some income back through. It might be the case that there's been deviation because the sale price that you planned isn't the sale price that you actually received or whatever it is. But actually, there might be some longer term issues there. It might be, it might actually be that you're paying off borrowing too quickly. It's not necessarily that your business isn't profitable. It's not necessarily the case that your business within itself isn't generating enough cash. But if you're trying to pay down your debt too quickly, you might run out of your working capital, your cash that you need to service the business day to day. On the other hand, and what's probably more common for poor cash flow, is that you have too much borrowing and you can't afford the monthly repayments. When we were analyzing accounts last week, one of the financial ratios I talked about was gearing, where that's basically the proportion of debt that a business is using to finance its operations. Being highly geared or being highly borrowed isn't necessarily an issue. Lots of new businesses, lots of progressive businesses, lots of expanding businesses have fairly high levels of borrowing, can be quite highly geared. But the problem is you need to be able to service the interest on that debt. And if you don't have the cash available to service the interest and the debt repayments, that can be really crippling to new growing businesses, even if they are profitable. The other thing might be that your personal demands, the demands on the profit, might be higher than the profit itself, that the demands in cash are greater than the increases in cash that we have through business operations. And that might be through your personal drawings. It might be that you might require the business to generate more cash for your lifestyle than it is. And identifying that as an issue is really important. So if your cash is tight, if there's particular pinch points, what do we do? What's our potential solutions there? What can we consider? The first is quite obvious. If things are tight, if we're getting close to our overdraft limit, if we don't have the money in the bank, we minimize and we just cut out non-essential spending. So that, and in that I have said that that's both business expenditure and personal expenditure. It might be the case that you wanted to invest in some new plant machinery. It might be, it might be the case that you were going to spend money on steadying repairs, whatever it is, unless spending is essential in a tight period in your cash flow forecast, you're going to need to absolutely minimize that down as low as possible. It might be more fundamental than that. It might be that you can't actually afford to make the level of monthly repayments that you're making. So actually, maybe it's a conversation with your lenders to say, well, actually, can we review this? Can we restructure it, perhaps over a longer period, so that I can pay back smaller amounts every month, every quarter, or however it is that that's being done. It might be that you're able to bring forward some sales, whether that's selling cattle earlier, selling grain earlier, or putting off purchases or spending. You might try and utilize trade credit to put off bills for an extra month or two and just explain that cash flow is a bit tight, but that if you're given another 60 days to pay, that there'll be no issue. Speak to your accountant, speak to any financial advisors, but speak to your suppliers and lenders as well. If you go proactively and say that I need more time to pay these bills, or I need to consider my options here in terms of cash availability, again, it's a much easier conversation doing it at a planning stage than it is 6 months down the line and you're already on that hard line and you need an immediate solution. Ignoring issues never solves the problem. If it solves itself, well, actually, if you'd sat down and looked at it, you might have realized it wasn't that big an issue in the first place. If there's genuine underlying issues in that business, sticking your head in the sand, which does happen quite often, isn't going to solve that problem. One that I've touched on already is you might have an ability to restructure borrowing. If you find yourself constantly in your overdraft, it's a sign that it's not really working for you and that's perhaps not the source of finance you should be relying on. I talked about sources of finance in one of the first meetings I had in this series, and thankfully nobody said that they were going to fund a farm purchase out of their overdraft, which I was glad to hear. But an overdraft is quite an expensive form of finance, generally speaking, not always. And it might actually be a better financial decision to convert a chunk of that overdraft into a fixed term loan. It would give you security over the repayments and planning those repayments, and it might reduce your finance costs that you're receiving. Ultimately, how do we manage the cash flow of our business? As far as possible, we should always try and match the timing of our cash outflows to periods of cash inflows. I've said that already. In agriculture, we're generally in a traditional agriculture, we're generally in a position where all of our cash goes out before our cash comes in. But trying to match this up as best we can, make sure that your business stays afloat, particularly even if it's profitable, we need to make sure that the cash availability is there. Be realistic in your plans. I fully appreciate that if you're presenting a plan to a potential lender, you want it to look as positive as I can do, to build their confidence in you. But as a management tool, be as brutal and be as harsh on yourself as you possibly can be. Be a pessimist. Can your business manage, and can your business meet the cash flow requirements over the next 6 months and the next 12 months? And if not, try and planning accordingly. It has to be reviewed regularly and regularly updated. Otherwise, going through all the effort at the start just becomes an absolute waste of time for you and everyone else involved. So do review it, use it as a live document and use it as a management tool. Have a go at it yourself. Yes, you can pay an advisor to do it. You can pay a consultant, an accountant, whoever it is, and actually they might be really instrumental in that process. But you're the person who knows your business best, and whoever it is completes your cash flow forecast for you is going to be coming to you for your specific knowledge about when these payments are made, about when this cash is received, whatever it is. They can help you through the process, but have a go at starting that process yourself. Is generally a quite helpful thing to do, and discuss it with your bank, your accountant, your advisor, whoever that may be throughout that process. I'm quite conscious of time, so I'm going to stop it there and we'll take the opportunity to have some questions. As I've said every week, there is much more information available through the Farm Advisory Service website. If you go to the section which is branded New Entrants and go to Business Skills, there's lots of publications, webinars, video recordings, podcasts, and tools you can use there for further help and further advice.
Thank you, Andrew. That's been a great tour of Cashflow. Again, giving a nice overview of what we can do if it goes wrong, because unfortunately we do know that in agriculture we're facing a lot of challenges. And I think we'll start with just a wee introductory question. Andrew, what do you find is the most common issue with cash flow in farming, especially for newly established businesses?
Yeah, I would say the most common issue that I come across is down to that problem that we have all these expenses up front, and actually you might have 10 months, 11 months of expenses before you have an income, whether that is lambs to sell or grain to sell, whatever it may be. That tends to be the biggest problem, is getting off the ground. If you're completing a cash flow forecast, to present to a lender, let's say you're wanting to borrow money to finance this, one thing that you might want to consider is that you actually borrow slightly more than you need as a way to service the repayments for the first year or two until you get into a stronger cash position. That might seem slightly counterintuitive, but it might be that you need to borrow a wee bit more just to give you enough cash in your bank account, enough working capital to be able to see you through those first months and years.
Yeah, and that kind of quite nicely leads into our next question there is, how do overdrafts work in terms of financing, forecasting, in our cash flow budgets, especially as we may need to rely on our overdraft a little bit more in the early stages?
Yeah, absolutely. So when I'm doing a cash flow forecast, so I'll actually pull that example back up on the screen that I had. So this is one, it was one, I did it a few years ago, but it was a genuine example. I've sort of simplified it for the slide. You can see here that I've got my opening balance and my closing balance each month. If I was in overdraft position, I would just be showing that as a negative figure. If you're preparing that as something for a lender, or if you're just preparing it for yourself, there's a few things to be aware of if you're in that negative overdraft position, which might be absolutely fine. Be aware of what your overdraft limit is, and that's where cash flow forecasts can really help you. In this circumstance, the lowest position we got to was in January 2026 when the closing position was £6,000. Now that was fine for this business, but it might be that, zero is the hard limit. And actually, if you're in an overdraft position and your overdraft limit is £100,000, if your cash flow forecast is demonstrating that you're going to get to minus 98, 99, you really need to be making some hard decisions there and maybe restructuring your plans for the year ahead. Another thing to consider if you're already in an overdraft position when you're doing this sort of thing is you need to factor in the cost of overdraft interest charges as well as just loan interest charges, which has been included in this example here.
Yeah, and then just as a wee practical point, if you're using your Excel spreadsheet to do your cash flows, you can put in conditional formatting for your overdraft limit there, just to highlight when you
Yeah.
might be above or below your target. And then, Andrew, we've spoken a wee bit about the sensitivity analysis, but should we have a minimum price to give us a warning for negative cash flow? Is there sort of trigger point that we could say, right, hold on, we need to watch out here?
Yeah, I think any forecast that you're doing, you should try and factor in some sort of, sensitivity. Um, whether that's saying whether that's saying, what happens if there's a 10 or 20% reduction, or what's happening if there's a minimum price. I think either of those are quite useful tools, particularly in the livestock trade at the moment. There's quite a lot of volatility. Um, there's a lot of confidence in the market, but actually, if prices were to slip, which they might reasonably do so, can your business maintain that? So yeah, I think there would be a benefit if you're doing a plan to say, well, actually, I'm basing this on, whatever price per kilo it is, and then factoring in, well, actually, what happens if it was a bit less? I think that's a very good idea.
Yeah, and just expanding on that a wee bit, Andrew, as well. When you're doing these 3-year forecasts, if we look back for the previous 3 years, where we've all been, we've had fertilizer going through the roof, we've had energy escalating, we've now had the livestock prices also being exponential. So
Yeah.
it's becoming like, if we think what's happened in the last 3 years, what's going to happen next 3 years to come, it's sort of like, do we need a crystal ball? So if we use the figures in this Bible, which is like sat on my desk every day,
There you go.
the Farm Manager Handbook, should we be putting on a percentage figure for potential increases or decreases on these factors for future years? Because the information that's in here is historic by the time it's published, just due to the nature of our systems.
I think so. I think so. There's only so much that we can plan for. I think lenders are quite aware of that. What we need to be able to demonstrate if you're filling out a business plan for a bank or something like that is your own ability to plan and your own financial competence. So I always think that starting with historic data is really good because it says, well, actually, here's a period of certainty. This is something I know that I can achieve. And then adjusting that with the best information you have at the time, as best you can. Obviously, when we get to the stage of planning for your year 2, year 3, I've done some 5-year cash flow forecasts before. And actually, when you get to that stage, it's a wee bit of a guessing game. But using the best information you have, stating what your assumptions are, is all we can do really. There's only so much we can plan for.